Hey, tech enthusiasts, welcome to Tech Stocks Daily, your go-to place for all things tech and stock market. We've got a packed show today, so let's dive right in. Today, Apple Inc. AAPL is making headlines, and here's the scoop. Despite lagging behind some of its peers since 2023, Apple is set for a remarkable turnaround, according to Wedbush analyst Daniel Ives. With a robust outperform rating and a sky-high $250 price target on AAPL shares, Ives bases his optimism on compelling developments and strategic moves by Apple. One of the key highlights from Ives' analysis is Apple's recovering stance in China. After a disappointing revenue decline reported earlier in February, new Asia supply chain checks are now showing a clear stabilization in demand within the region. This is particularly significant for iPhone units, predicted to showcase incremental growth soon. This growth trajectory is anticipatively hinging on the upcoming iPhone 15, expected to trigger an upgrade cycle beyond what Wall Street has forecasted. But that's not the only thing cooking in Cupertino. Investors have been buzzing about AI coming to Cupertino, signaling an optimistic future for Apple's stock. The buzz around conservative iPhone guidance and the continued, rock-solid double-digit growth in Apple's services business paints a hopeful picture. Ives envisions a Super Bowl moment for Apple with the unveiling of generative AI technology at the forthcoming WWDC in June. This, paired with the introduction of a standalone AI app store, is seen as a groundbreaking monetization opportunity that could rake in over $5 billion annually for Apple. Crucially, amidst fierce competition and geopolitical challenges, Apple's stronghold over 200 million active iPhones in China appears unshakable, reinforcing the bullish outlook for Apple's positioning in China and beyond. What do you think about Apple's strategic moves and potential growth in the AI space? Drop your thoughts in the comments below. And if you're enjoying the latest in tech stocks, don't forget to like, subscribe, and share for more daily updates. Microsoft Corporation, MSFT, is lighting up the news today, folks, and for a very compelling reason. If you've ever pondered what a smart investment in tech looks like, Microsoft's history provides a shining example. Here's why. Back in 2003, Microsoft began paying dividends to its shareholders, which at the time might have been interpreted by some as the end of its rapid growth phase. However, this move was actually a testament to the company's enduring strength and its ability to generate increasing revenue annually without proportional rises in operating expenses. Essentially, Microsoft had reached a stage of escape velocity, where its operating leverage began to produce significantly more free cash flow and earnings. Since declaring its first dividend, a modest 0.16 cents per share, or 8 cents after a stock split in February of that year, Microsoft has soared to impressive heights. Transitioning from primarily selling the Windows operating system and Office suite in 2003, Microsoft today is a behemoth with its server platform business, bolstered significantly by its Azure cloud computing platform and other significant shifts, including transitioning Office to a largely software-as-a-service model. Flash forward to the first half of fiscal 2024, Microsoft boasted nearly $119 billion in revenue, netting $44 billion in income and producing $49 billion in cash from operations. A hypothetical investment of $1,000 in Microsoft stock immediately following the dividend announcement in 2003, buying you 38 shares after the split, would be worth about $15,700 today, solely from share price appreciation. When you include dividends, which would amount to $1,067 in that time frame, and if you'd reinvested those dividends, your total investment would climb to around $24,800. To put it in perspective, a $1,000 investment in the S&P 500 index fund over the same period would have grown to about $8,300, barely a third of what you'd have achieved with Microsoft. Microsoft has continually shown robust momentum, raising its dividend almost every year, now at $3 per share annually. The outlook remains promising, especially with investments like OpenAI positioning Microsoft's Azure platform as the go-to for AI developers. This positioning keeps shares attractive even as they hover near their all-time high. The broader lesson here is crystal clear. Investing in a tech company as it commences dividend payments can be smart. Not only does it indicate the company's ability to leverage fixed costs and grow earnings, but it's also not an admission of a lack of investment opportunities for growth. The successes of Azure, the transformation of Office, and the acquisitions of LinkedIn, GitHub, and Activision Blizzard all stand as testaments to Microsoft's strategic investment savvy. In the tech investment world, have you come across stories as inspiring as Microsoft's journey? Share your thoughts in the comments. And if you're loving this trip down investment memory lane, be sure to hit that like button, subscribe, and share for more content like this. NVIDIA Corporation is grabbing headlines today, and let me tell you, it's all about artificial intelligence, AI. The company's shares have rocketed up 38% year to date, and we're just 6 weeks into the new year. So what's behind this meteoric rise? Simply put, AI. NVIDIA, known for designing the world's leading AI chips, graphics processing units, GPUs, has witnessed an explosion in demand for its products. This demand comes at a time when the International Energy Agency, IEA, forecasts that energy consumption by data centers, a substantial market for NVIDIA's chips, could double by 2026. This growing AI infrastructure is a massive boon for NVIDIA, whose GPUs are highly sought after for their power, speed, and efficiency. Let's talk numbers. NVIDIA's revenue over the last 12 months hit $45 billion, a significant leap from $26 billion just a year earlier. Looking forward, sales estimates for NVIDIA's next fiscal year are eye-watering, with consensus estimates pointing to roughly $110 billion, more than doubling its current revenue. These optimistic revenue forecasts have prompted analysts to hike their price targets, with Rosenblatt Securities' Hans Mosesmann pegging the stock could climb to $1,100, now a 59% upside. For those already holding NVIDIA shares, it's a moment of triumph. Amidst this success, the advice leans towards resisting the temptation to sell. As the Motley Fool underscores, letting winners run is key, smoothing out the volatility to secure substantial long-term returns. For those yet to hop onto the NVIDIA bandwagon, it might be time to give it a thought. Despite the significant gains over the past 15 months, the AI revolution's momentum suggests there's still room for growth. With increasing sales estimates as companies heavily invest in AI solutions, NVIDIA stands as a pivotal player. Echoing Peter Lynch's wisdom, finding a few standout stocks can make all the difference in your investment journey. And for many, NVIDIA is shaping up to be one of those once-in-a-lifetime stocks. What's your take on NVIDIA's explosive growth and its future prospects? Dive into the comments and let's discuss. Don't forget to like, subscribe, and share for more updates on the movers and shakers in the tech world. TripAdvisor Inc. Trip is making waves in the news today, and it's all thanks to Viator, a platform it acquired nearly a decade ago that's now showing incredible growth potential. Though TripAdvisor has traditionally been known for its travel reviews, the acquisition of Viator has introduced a new profitable avenue that mirrors the business model of Airbnb. That is, third parties list bookable experiences on the platform. Travelers make bookings, and Viator collects payments, pays the organizers, and keeps a cut for itself. In the first 3 quarters of 2023, Viator generated revenue of $576 million, a staggering 57% increase from the same period in 2022. This growth is significant, especially considering the entire company is on pace to generate just over $1 billion in total revenue for the year. Viator accounted for 46% of the company's total revenue in the third quarter of 2023, solidifying its position as a crucial component of TripAdvisor's business. Despite this promising growth engine, concerns persist regarding TripAdvisor's overall profitability. The company has historically maintained high margins, but profits have been scarce due to high sales and marketing expenses. Compared to peers like Airbnb and Booking Holdings, TripAdvisor spends the most on sales and marketing relative to its revenue, which has been the slowest to grow among the three. The worry is that TripAdvisor's growth might be overly dependent on this spending, which could inhibit its ability to generate meaningful profits for shareholders. However, there's optimism around Viator's potential to drive organic traffic, similar to Airbnb, which could allow TripAdvisor to achieve operating leverage as Viator scales. If this scenario plays out, TripAdvisor, with its market cap of only $3 billion, could be a highly valuable investment for those looking to capitalize on the growing travel experience market. Brian Chesky, Airbnb's co-founder and CEO, has even referred to travel experiences as an Amazon-sized opportunity, highlighting the significant potential for growth in this sector. What's your take on TripAdvisor and its Viator platform? Can it overcome its profitability challenges and capitalize on the booming travel experience market? Share your thoughts in the comments. And if you're hungry for more tech and travel stock insights, don't forget to like, subscribe, and share for more daily updates. Today's quirky tech news comes from Google, which is set to enforce new guidelines targeting unwanted mass email senders starting in April 2024. If you've ever been bombarded with spammy newsletters or promotions in your Gmail inbox and thought, enough is enough, well, Google's right there with you. In a move to protect Gmail users from an avalanche of unwanted mass emails, Google has announced an increased crackdown on senders not adhering to its new email sender guidelines. From April, a percentage of non-compliant email traffic will be rejected, with the percentage gradually increasing over time. Google's approach is clear. If 75% of the traffic meets the guidelines, expect the non-compliant 25% to start seeing rejections. While the exact rejection rate isn't disclosed, the intention is crystal clear. This isn't just a small tweak. It's a significant shift aiming to double down on sender-side security and amplify users' control over their inbox contents. Bulk email senders, specifically those sending at least 5,000 messages a day to personal Gmail accounts, are required to authenticate outgoing emails and avoid sending unsolicited messages. And there's a twist. bulk senders have until June 1st to implement a one-click unsubscribe feature in all commercial and promotional messages. So while these guidelines aim to safeguard personal Gmail accounts against mass email floods, professional Google Workspace accounts aren't exempt from these new requirements. The bottom line? These measures are set to greatly reduce the risk of phishing by ensuring that emails come from verified senders, enhancing users' trust in the legitimacy of the emails they receive. In a lighter vein, if you're a marketer who's been overly enthusiastic with your email blasts, it might be time to rethink your strategy. Google's tightening the leash, and it's doing so with a gradual yet firm grip. Think of it as Google's way of telling bulk email senders, we're watching you, and so are our algorithms. And there you have it, folks. Today's slice of quirky tech news that could make our inboxes a little less cluttered and a lot more secure. What are your thoughts on Google's new move against mass emails? Are you ready for a cleaner inbox? Or does this change your marketing game plan? Hit up the comments with your take. And for all your daily dose of tech quirks, news, and insights, don't forget to like, subscribe, and share. All right, folks, based on today's bustling tech news, let's dive into a little stock market strategy and pick 3 stocks to make some moves on. 1 to sell, 1 to buy, and 1 to watch. Let's break it down. Stock to sell. TripAdvisor Inc. Trip. Why sell? Despite the promising growth of iotr, TripAdvisor Inc. faces significant profitability challenges. The company's high sales and marketing expenses, relative to its revenue, are a concern, especially when compared to peers like Airbnb and Booking Holdings. With TripAdvisor's growth potentially overly reliant on this high spending, there are valid worries about its ability to generate meaningful profits for shareholders. While Viator presents a growth engine with its 57% revenue increase, the overall profitability issue makes Trip a stock to conselling from a risk management perspective. Stock to buy. NVIDIA Corporation. Why buy? NVIDIA is riding the monumental wave of AI innovation, with its stock soaring by 38% in just the first 6 weeks of the new year. The company's GPUs are at the forefront of the AI revolution, and demand for these chips is skyrocketing. With revenue estimates for the next fiscal year expected to more than double to roughly $110 billion, NVIDIA's strategic position in AI development and its impressive financial performance make it a compelling stock to buy. The company is not just growing, it's thriving at the nexus of tech's hottest trend, artificial intelligence. Stock to watch. Apple Inc. Why watch? Apple has been somewhat of a laggard among its peers, but is on the verge of a significant turnaround, particularly in China. The iPhone 15 is expected to trigger an upgrade cycle that surpasses expectations, and the anticipation of Apple's unveiling of generative AI technology could represent a Super Bowl moment for the company. With investments in AI, a stronghold of over 200 million active iPhones in China, and expected annual incremental revenue from AI over $5 billion, Apple is a stock to keep a keen eye on for potential growth and strategic shifts in one of the tech industry's giants. Wrap up. There you have it. Based on today's news, TripAdvisor could be a sell due to profitability concerns, NVIDIA is a strong buy on the back of the AI revolution, and Apple is one to watch closely with its expected strategic moves and technological advancements. What do you think of these picks? Agree, disagree, or have other suggestions? Jump into the comments below, and let's get the discussion going. Don't forget to hit that like button, subscribe for more daily insights, and share this video with fellow tech and stock market enthusiasts. And that wraps up today's dynamic market activity. From Apple gearing up for a potential rebound in China and the world of AI, NVIDIA championing the AI revolution with its unparalleled growth, to TripAdvisor navigating the rough waters of profitability while betting on the burgeoning travel experience market, it's been a day full of strategic maneuvers and investment opportunities aplenty. As the tech landscape continues to evolve, today's storylines underscore the importance of keeping a close pulse on market movements, technological advancements, and strategic shifts within key players. Whether you're strategizing your next move, considering new investment opportunities, or just keeping up with the tech stocks buzz, there's never a dull moment in the world of tech stocks. Remember, the market waits for no one, and today's insights could be tomorrow's gains or lessons. Stay tuned for more updates and keep the conversation going in the comments. Thanks for joining us today on Tech Stocks Daily. Don't forget to like, subscribe, and share for more curated tech and market news delivered straight to your feed. Until next time, stay savvy, stay smart, and keep investing wisely.